Let's see where the actual open is happening. It's pretty much flat actually. There's no fireworks at all. 19,675 is where we are at for the Nifty. But the good news is the advanced decline ratio. Look at that advanced decline ratio. Almost 1,300 stocks advancing to 250 stocks declining. And again, it's the mid-cap and the small-cap index which is outperforming, while the Bank Nifty is pretty much flat for the trading session. In terms of the sectors, it's energy, which has started on the front foot. So all the Adani group of stocks, Adani Transmission, Adani Green, Power Grid, NTPC, they've all opened in the green. And IT2 has been doing okay. So, of course, there was numbers coming in from Capgemini over the weekend and the con call commentary as well. They've held on to their FY23, their calendar year guidance. And that's the reason the IT index has also managed to hold in the green. Autos, they're doing all right. You have Bosch, which has started on the front foot. And similar is the case with Tata Motors as well. From the broader markets, though, watch out for Power Mech. That stock is firing away in the trading session. A big, large order win for Power Mech, a 30,000 crore order win coming in. And that's the reason that stock is high around 20%. 5-star is the other one, which is locked up around 15 to 20% higher. So watching out for that. You also have names like Cocoyo, Camlin, etc., which are doing quite well in the trading session. They've opened with a gap up of around 10%. On the losing side, it's NLC India, which is on the back foot, so watch out for that. And of course, let's also see what's happening with the likes of Marico, etc., because we're watching out for the margin guidance upgrade that came there, but the street is still not liking the muted volume figure. And then Siemens was the other one that we were watching out for. The minority shareholder activism coming at play, and that's the reason that stock is high around 5%.
In addition to the kind of stellar move, as we highlighted earlier, that the stock has seen in the last 6 months or so. Within the broader markets, well, it's a smart gain actually for the small cap end of the market. So that's holding out a nice degree of outperformance by about 0.5% or so. And I just want to identify some of the names within this basket. Indiabulls Housing, for instance, DCM, Triveni Engineering, First Source, Credit Access, as well as KEI. Those are some of the smart movers. Kunal, your view on the entire the market move that we're seeing this morning at 19,600, just about holding on to this level by the skin of our teeth. Are there chances that we breach this level on the downside? And share with us your first trade.
So far I think it's an okay opening for the indices. We're still holding on to that 20-day moving average for the Nifty, which I believe could be an important or a critical parameter for a near-term play. So I think till the time we hold on to that level 19,525 on the spot, that's the level for the index. So that looks to be an attractive proposition to try and buy or go contra the closer we are towards that 22 moving average for the index. In terms of opening trade, Tata Chemical is something which looks attractive. In fact, the stock has broken past above after 5 or 6 months of straight consolidation. So at 1,020, 30 plus levels, that's a stock which I'll look to trade in the open.
Okay, so Tata Chemical, that comes as a buy. Just quickly wanted to flag out some more stocks. Piramal Enterprises, take a look at that one. That's opened with a cut of almost 7%. Of course, earnings were on the weaker side, but one was hoping that the buyback support is something that will hold that stock, but that's not the case. Let's pull up the chart of Piramal Enterprises, please, because that one is showing a bit of a downtake. Then you have SBI Card, which is down a good 4%, and M&M Financial 2 has opened on the back foot with a cut of around 3%. UBL2 is down almost 2 to 3%. We should pull up all of these counters. On the gaining side, of course, Nazara is trending higher, and then Chalet Hotel is the other one. But Naresh, quickly, your first trade?
So that would be a buy on Apollo Hospitals, opening up a little bit of a gap down. Looks promising at this levels. A small stop loss here at 52.40. Expecting a bounce here.
Okay, there you have it. That's the view coming in on the overall markets. Let's connect then with Aman Chauhan, who's joining in to discuss the road ahead and what we can expect by way of triggers. Thanks much for taking time out. Just wanted to get in your thoughts first up, Aman, as to what do you believe is going to be the next big trigger that the markets are going to watch out for, given the fact that now earnings seem to be behind us?
Frankly, there are no immediate local triggers. I think market is going to take clues from the global markets. It's been a global rally since the last 4 months, and India has also participated in that. And I feel that is what's going to be the theme of the next few months also. So post the earnings season, immediately there is no trigger. The only trigger now is, I think, November, December, the state elections, and that's still some time away.
Immediate domestic triggers as such, but talking about earnings itself, the earnings season has been all right for the entire financial space. We have seen either inline set of numbers or a beat coming in versus expectation. Are you looking at broadening your horizon when it comes to financials? A lot more PSU names, a lot more smaller micro lenders, etc.?
Yeah, the financial space looks good, and within financials also we are pretty positive on the microfinance. We are pretty positive on the housing loan segment NBFCs, which are leaders in their respective space, and I expect this rally to spread. More and more mid-sized private banks can also be looked at, and that is also trading at decent valuations, and that is something where I think the investor interest will soon come in.
How you been?
Hi.
Yeah, I was hoping you hear my voice and there would be a lot of excitement in terms of saying a hi. Delay sound कर रहे हो?
Yeah.
With
I'm pretty fine. How are you doing, Nikhil?
with railway stocks, with NBFC stocks, with manufacturing stocks going higher, I was hoping that there would be a lot of garmahat in your voice. But we'll keep that aside for a cup of coffee. Let's understand what is in store for investors now. For those who are looking at, let's say, investing fresh money or fresh capital, should they expect a meaningful upside in next 1 year, or market returns will not be exactly like what we saw in last couple of months?
Last couple of months has been a one-way rally, right? So one cannot expect the same kind of return in the next 6 months. If it happens, it's an additional bonus, but that should not be the expectation while coming in. You should expect a high single-digit or say mid-teen kind of returns. If you get returns anything excess of that, that's an additional bonus. But that should not be the criteria for one to look at equity markets right now, because last 4 months, as you know, it's been a tear, right? So it's been just a one-way market, and that should not be the base case.
You bought a lot into railway stocks, and I want to bring that theme out because that theme has done exceedingly well in the last couple of months. At this current juncture, when railway stocks have started commanding P multiples of almost like capital goods stocks, is it time to get out of railways, defense, construction?
Yeah, so we are positive both on cap goods as well on the railways teams, but within that one needs to be careful, right? So if stocks start trading at 30 times FY26 multiples, that's not a level where one should be looking to invest into these names. There is a good runway. There's a good runway for the next 2 to 3 years at least, because most of the railway stocks are seeing good order inflows. The companies that we have invested, the capacities are booked for the next 3 years. But beyond that, for growth as well as for the existing demand to sustain, continuous flow of railway orders should come in. So while the next 2 years is set, one needs to see as to how the railway ordering pans out. So markets seem to be already discounting FY26 numbers also, and that's what the peak turnover could be. So one needs to be careful. I would not get into railway stocks or cap goods stocks in north of 30p. If something is there around 15-20p, then it should be considered, because the traction is there. The kind of ordering activity we have seen and the kind of modernization that's going to happen in the railways, this is definitely a good interesting space to look at.
Exactly a year ago, we had a conversation on mid-tier banks. I said no, you said yes. And the conversation was that mid-cap banks will struggle in a credit cycle because large banks were gaining market share. We are in a setup where both are gaining market share now. How do you see the situation moving for mid-cap versus small-cap banking? Because the deep discount which was there a year ago, I think that's missing now. Is it time for me to say yes and time for you to say no? Could it reverse?
Difficult to say. So what we are seeing right now, that there is a sectoral tailwind. So all the financial institutions are benefiting, and we are at the, you can say, if not immediately, but in the next 6-9 months, we can see a rate cut happening, and that can be a very big trigger for all the financial stocks to go up, both large cap banks as well as the mid cap banks. So within that, I think now from here on, banks that can gain market share and that can improve on the NIMs is what is going to do well. We have seen HDFC Bank as a stock, it has not done well versus say what an ICICI or an Axis or you say even an IndusInd Bank has done. Similarly, in mid-cap banks, City Union Bank has not done that well, or there are other banks that are not done well versus say what another performing mid-cap bank or say microfinance stocks have done well. So from here on, whoever can handle the NIMs well would be a clear performer. I don't think there is going to be a large cap versus mid cap differentiation now. It's going to be very stock specific, both in the large as well as in the mid caps.
So financial seems to be the consensus trade that you're talking about, but which is the most underrated sector you would say, Aman? Is that technology?
Technology, yes, but at the same time, stocks have not corrected the way the results have been, the way the Infosys revises guidance. That's not being a much impact on the stock price. So I think there's another 1 or 2 quarters before which people start looking at technology. Chemicals is one space which is underrated right now, because clearly we are seeing earnings headwinds. We are seeing margin pressures because China's supply has opened up. So that is also something for the next 3 to 6 months. One should be very watchful. Don't jump in right away, but there will be an appropriate time to look at the chemical sector also. So both these sectors right now are being, you can say, not ignored, but not the market favorites. But in the next 2 to 3 quarters, they can get interesting.
Okay. So let me divide my next question in perhaps 3 parts. First, for next 3 to 5 years, what to your mind is the big trend? For example, buying into railways and defense was a big trend. That's part 1 of my question. Part 2 of my question, what to your mind could be a tactical trade right now? For example, it could be metals, it could be autos, it could be chemicals. And third part of my question is that where do you see market right now just not just over believing in that trend, manufacturing or whatever you think? So 3 parts to my question.
First, the mega trend could be one where we see a shift from unorganized to organized. So whichever sectors, whichever companies are facing unorganized competition, I expect a clear market share shift happening from unorganized to organized. It could be because of GST, it could be because of new policies by the government. So this can be a good mega trend where the organized sector will gain market share. Second, sorry, I missed just second question.
Tactical trade, tactical trade, just for the benefit of our viewers, where you think that next 3 to 6 months, a 15-20% upside could be there on the table.
We are positive on metals from here on, and that can be a tactical trade for the next few months. Expect dollar to softening, and that can help commodity prices, which in turn will get reflected in the stock moves also. And the third one, we are clearly avoiding chemicals right now. So we have pared down our exposure to chemicals also, because in the near term, there is a significant headwind both on the volume front as well as on the margins. So very few companies within the sector are benefiting from lower raw materials, but a longer list of companies are facing headwinds because of lower chemical prices. So that is something that we are clearly avoiding, and these companies still trade at north of 30 multiples, right? So not something which is a very exciting valuation either to look at. So if there is no earnings growth, I don't see any reason why this 30-35 multiples should sustain.
Aman, what's your view on autos? Do you think that big upside is already made and now there'll be just a bit of sideways move on the auto, or more legs to the rally?
We have not been a very big bull on the auto sector. We have some auto ancillary stocks in the portfolio, but nothing on autos directly, because we feel Indian companies are not well prepared for the EV, and EV is still a very small component of some of the companies like Mahindra or Telco. That's the reason we don't have a big auto exposure, and I think we'll maintain that stance. I don't see myself getting into auto stocks anytime soon.
Final question, in terms of the valuation setup and in terms of the global macros, do you see a risk to the market, or do you think that we may not rise higher from here, but a reversal and a sharpish volatility is unlikely to come in?
So markets have done pretty well. There can be a round of profit booking. I don't see a sharp correction, but as after, see, mid caps have gone up anywhere from 50 to 100% in the last 4 months. So a 5, 10, 15% correction or a profit booking can easily happen. But I don't see markets just dropping off the cliff. It's not that the bull market is over and we should be fearful about something, because there is no reason to suggest that. the whole rally setup which has happened in the last 4 months is also because of the fact that people are pretty excited the way CSFB and the regional banking crisis in the US were resolved by the central bank. So now everybody is of this view that anything goes wrong, the central bank will step in, and in a week, 10 days time, they will address the issue, and there won't be a contagion kind of an impact. And that's what is fueling the bulls. And I don't see any reason why this view can change. And on top of that, we are sitting on the macro setup where interest rates are bound to come off. Inflation is coming off both because of slower demand and the base effect. And if that sustains, which is very likely, then we are heading for a rate cut cycle, which is also a fodder for the bull. So keeping these two things in mind, I don't see any reason why the markets can see a sharp fall. But having said that, it has risen quite sharply in the last 4 months, and a small time correction or say profit booking can definitely come in.
Okay, Aman, on that note, we'll let you go. Thank you so much for joining us. Before we move forward, a quick stock of a few of these buzzers. Piramal Enterprises, that's moving on heavy volumes, as we were pointing out earlier as well. That stock has taken a knock of almost 6.5–7% now. NLC India is the other one, and then Green Panel. Important news update as far as Kotak Mahindra Bank is concerned, and this is what agencies are reporting. Just the first flash that we have, wherein they are saying that Kotak's succession plan is set to be under RBI scrutiny. It's not fresh news completely. We of course know that there's a succession planning which is underway, but the big question is, when will we hear conformity about that, because there are a lot of names in the play, and of course for banking names, leadership remains a very important factor. So let's wait when we get those final names, or at least contenders as far as that bank is concerned. But let's shift focus and welcome on board Mr. Rahul Mittal. He is the Chairman and Managing Director at RITES, joining us on the show. Rahul, hi. Thank you so much for making time and speaking with us. Well, I was looking at your Q1 performance, and it doesn't look very impressive. Whether you look at it on a year-on-year basis or sequentially, there's a decline in terms of revenue, EBITDA, as well as profits. I understand that partly it's account of the export revenue being lower. But could you talk to us about that? Is there going to be some bunching up in Q2, Q3 that we should expect?
Good morning. So let's break down the Q1 performance. As you correctly said, when we started this FY, our strategy was to minimize the impact of our two challenges. One was this export stream, and the other was the change dynamics in the QA, that is the inspection stream of business. In the export stream, the FY started with an order book of only about 100 crores, and that had an impact in this quarter of about 16 crores on our profits. In the inspection stream, you see the new order of railways started cutting in this quarter. And in that, the rates are about 1/5 of the earlier rates, and that impacts about 60% of my QA business. So that had an impact of about 10 crores on our profits. So what we did was we focused on the non-railway client base, rationalized our costs, and more importantly, we made focused efforts to grow in the high margin consultancy orders. And our consultancy business grew 10% year on year, and we could save margins at about 44%. And you know, this along with an increased profit of 10 crores from our subsidiary RMCL could minimize the impact of these two challenges to a drop of about 19 crores in the EBITDA, while maintaining our core EBITDA margins at 29.6% and our PAT margins at 21%.
All right. Morning, Mr. Mittal. I just wanted to also talk about, the infra capex, because on the one hand, that has been strong, and on the other hand, there has been that decline in the consultancy revenue. You brought that up as well. What is the outlook in terms of how you plan to deal with some of the private players, how you're looking to take on that competition?
No, in fact, to correct you, the domestic consultancy revenue grew year on year by 10%. And that's our post trend. The drop was in the export stream of revenue and the inspection stream of revenue. So in terms of consultancy, which is in fact, if you see this quarter itself, we got about 70 orders totaling to about more than 300 crores across sectors. And that's our niche strength. We got the Hyderabad Airport Metro order. We got orders for the Chandigarh Metro, for expansion of the Gurgaon Metro. We got orders for, the comprehensive mobility plan for Kolkata city. Sustainability, we got orders in the Swachh Bharat mission. So across the various streams, and that's our niche strength, we grew in our consultancy stream.
So one has to look at FY24. Will it be any different from FY23 in terms of, like you said, that there is a cyclicality in the business and that's how it moves? How will FY24 be different from FY23?
You see, FY23, the export revenue was high because these were pre-COVID orders and the shipment happened in 21, 22 and 22, 23. As I mentioned, we have been making all efforts and we are quite confident building up on this strategy as we did in Q1 that down the coming quarters, our export stream should start generating some revenue, which is a good top line and a good margin stream of revenue. Similarly, with the change dynamics in the QA business, which I mentioned, the inspection business, and our building up on the non-IR client base in an aggressive manner, we should be able to recover lost ground in these two streams. And in the domestic consultancy as well as international consultancy stream, which is our core niche strength, and as you saw, Q1 saw growth in that. We will continue to build up on that and leverage this strength, especially the increased capex allocation.
So having said that, what we're trying to get from you is what will be the kind of revenue growth and margins that we should expect for FY24 as a whole?
You see, we are a consultancy company and our strategy and taking orders are driven, we're a bottom line driven company. So our all strategy across our streams of revenue would be one to reach at least the levels of the profits and as last year and try to improve on them in spite of this dip in the Q1, as well as maintain the margins in spite of the increased competition and in spite of two major streams of high margin streams of business taking impact in Q1.
Lastly, a quick word on the order book. I understand it's around 5,700 odd crores, but in terms of the pipeline, how does it look like and what part becomes executable this year?
Yes, you're correct. 5,700 crores is our order book, which has consultancy as about 2,700 crores. Turnkey business is about another 2,700 crores. The export is now only 50 crores. Leasing is 150 crores and RMCL, our subsidiary, is about 100 crores. So consultancy will be our main push to maximize the high margin orders so that these give us good margins as well as try and keep the turnkey execution of the key turnkey orders so that they add to my top line. And as I said, the key focus will be to try and get some finite export tech orders which can start contributing to my revenue by the end of the FY.
Okay. If your consultancy business is growing and eventually if it grows higher, will you have advantage of operating leverage, or like consultancy, if I look at other consultancy businesses, when they grow bigger, they are unable to scale up in terms of margin because the demand and the customer also starts squeezing out more?
So that's a very valid point. In fact, we operate across 10 different verticals across all sectors of infrastructure, and that's our strength. So while some of these sectors have very increased competitions, having an impact on my margins, there are some core strength areas where we are able to, still maintain our margin. So it has to be a mix of both. And that's our strategy, to get more orders in our high margin areas, maximize their execution while also continuing to get orders in the, tough margin areas. So in fact, this is the first quarter where our vision of having, strengthening our consultancy revenue, because consultancy revenue has contributed 53% of the total revenue. So our vision is that they should always be above 50%. And that is what we'll build up upon.
All right.
All right. Thanks so much then for taking time out and giving us a view as to how things are shaping up, Mr. Mittal. Good to have you on board with that outlook. That's the management of RITES talking about how they are going to grow the consultancy business because it has been stronger vis-a-vis exports, and they are focused on non-rail orders as well. That's the stock price at 462. Just a quick check-in as to what the level is on the frontline index at 19,648. You've got the broader markets pretty much neck to neck. P.N. Vasudevan is the MD and CEO at Equitas Small Finance Bank and now joins in to talk about the fine print of the Q1 numbers. Thanks much for taking time out. Let's start off with the net interest margins. They've fallen below 9%. Is this just a temporary blip? Do you think that things can stabilize to around 9% as was earlier guided by you?
See, the cost of funds, as you might have noticed, has gone up in the first quarter, and there's a proportionate reduction in the NIM also. We expect the cost of funds to go further up in the next few quarters also, because many of the old deposits are getting repriced at the higher rates now, current rates. So we should see the rates, interest rates going up further in the next 2-3 quarters. Which means there should be a proportionate impact on the NIM also. We have been able to increase our lending rate over the last 1 year. It's almost, we have increased our portfolio yield, disbursement yield by almost 0.5%. But the impact will still be there on the NIM. So what we expect is that our cost of funds might go further up from where it is currently by nearly about 40 to 50 basis points. And so NIM also should come down in the same range of 40 to 50 basis points. Last year, we had a NIM of 9%. This year, for the full year, we expect it to be around 8.5%. So from 8.75 in the first quarter, it may go all the way down to about 8.25 by end of the year. So that for the full year, we may probably end up with an average of 8.5%.
Okay, so NIM is around 8.5 because you're seeing cost of funds go up going forward. But then what are the levers that you see for NIMs to stay around that 8.5% mark as well?
Yeah, by and large, yes. Because as I said, our disbursement yield has actually gone up by 0.5% over the last 12 months. There's also, you must understand that there's also a product mix change which happens in, in new and startup banks like ours. There's always a product mix change also, which again, does have an effect of decreasing the yield. But yes, broadly speaking, our NII growth should be driven largely by the disbursement growth over the next few quarters. And the NIMs itself should, as I mentioned, probably go down to 8.25 by end of the year. But for the full year, we are talking of an average of about 8.5.
Okay. Now you are well above your growth guidance. What is aiding to your growth and what is your sense in terms of sustainability? And if you are above your growth guidance, which you must have given, look, because market conditions were different, could you be revisiting your earlier guidance?
Yeah, absolutely. I think our deposit has been coming along very well. And, our retail term deposit, actually, we had the best ever quarter so far as a bank in the first quarter. So the deposit growth has been quite in line with the advances growth, and we don't see any particular concern from the deposit side. Of course, you might have noticed that our CASA ratio has come down. CASA in terms of amount remained flat Q on Q, as a result of which the percentage of CASA has come down. But that, I think, again, is an industry-wide issue because the interest rates on deposits are so attractive today that customers, depositors, do want to take away as much as possible and lock it into a term deposit and earn a higher interest rate. So we also see a significant flow from CASA from savings to deposits. So our CASA percentage has come down, but overall our deposit growth has been very much comfortable to support the advances growth.
Okay. And how should one look at ROAs therefore? Because the net interest margin pressure is expected to sustain. You continue to maintain your ROA guidance of 2.25 to 2.3% that you maintained last time?
See, basically, we will try and see whether we can deliver around the 2% level. I think that should be our focus for this year. About 83% or 84% of our loan book is actually on a fixed rate basis, which means that obviously in a rising interest rate scenario, then our portfolio is the one which will have the largest impact of NIM. Given that scenario, I think for the current year, we should be it should be a really good performance if you are able to deliver anything in the range of around the 2% level. And then maybe next year, when the interest rate cycle generally is expected to kind of start stabilizing and reversing, that's the time when you will see that portfolios like us will actually start seeing the the benefit of a larger fixed rate loan book. And so we might get back to that slightly higher level of ROA maybe next year. This year, I think it will be a challenge and it will be a good challenge if we can manage to maintain it around the 2%.
Okay, and Mr. Vasudevan, before I let you go, can you give us an update with respect to the universal banking license? What's the timeline for that?
We had a regulatory licensing condition which had to be met by merger of our holdco with the bank, which we have done in the month of February. And so technically now we have kind of cleared all the conditions of our license. So we are now technically qualified to look at applying. So we'll be, there has to be some kind of a guideline. Probably the regulators may come out with at some point in time as to what basis a small finance bank can apply for a universal bank license. So they might probably put out certain conditions of such conversion. And as and when that comes out, we will have to study from our side whether we meet all those conditions. And then if we satisfy those conditions, then we would definitely be keen to apply. In terms of timeline, obviously, there's no particular defined timeline at this point in time. We have to just take it as it comes.
Okay, Mr. Vasudevan, on that note, we'll let you go. Appreciate you joining us on the show. But let's talk about Kotak Mahindra Bank as well, because that's seeing a bit of a slip from the way it started. It's now down 0.6%. The latest news, of course, coming in, Nikunj, that RBI is looking at scrutinizing their succession plan. And it looks like what they want is an outsider to take over.
Look, this is something which is source-based. So even if you assume here, Mr. Kotak's exit, for someone who's built one of the most enviable franchise in the banking sector, his succession is something which markets have debated and deliberated, whether it is an external candidate, whether it is an internal candidate. Reserve Bank of India may actually give their view about the internal candidate or an external candidate, but ultimately we don't know the names the board has proposed. There of course was a buzz, there was a belief that there is going to be an internal candidate who could be succeeding Mr. Kotak. But looks like, if this report is to be believed, that there could be Reserve Bank of India really wants the board to consider an external candidate. Who, when, why? Have we heard anything from Kotak Mahindra Bank? No. Have you heard anything from RBI? No. So right now it is speculative, but yes, Mr. Kotak's succession is something which would be perhaps one of the most watched things, I guess, for the banking sector, for the shareholders, and even for media per se, because we are looking at an era where a man who's really turned around an NBFC to a world-class bank to a Nifty 50 stock, that is something which really could have ramifications. And we've seen that happen. For example, Mr. Puri's exit, even though it was a planned exit, even though Mr. Kotak's exit is a planned exit, that gave good bumps and that gave some anxious moment for shareholders when that migration happened. And the bankers, they play a role. Look at one classic case here, ICICI Bank, under Chanda Kochar, under Sanjay Bakshi. What a transformation it's really been. This is the one sector, the understanding of risk and the process and understanding the customer, I think, is very, very important. In technology, you still automated. In manufacturing, you're still automated. In banking, it's about judgment. And judgment is based on experience and data and the strategies you follow. For example, Kotak never went into microfinance. They're not known for taking high risk. They give low. They are very conservative in terms of the growth they want to follow. But in the downturn of 2015 and 18, their balance sheet did not get hit. While other banks, they really suffered. In this upturn, they've been conservative. So they are not growing. So the person who really is going to be running a bank more than a, it's not about system, it's really about understanding and experience which makes the difference. There are some sectors where you can say that, you're agnostic to what's happening at the CEO level. But in financials, I mean, the man at the helm really matters.
Yeah, and it's emerged as the fourth largest private sector lender, and it's going to be later on in this year that Uday Kotak will be ending his tenure. So let's see how things pan out. Yeah, that's the latest news, that the banking regulator is nudging them to select someone outside the ranks of the lender currently to succeed him. Okay, let's shift gears then and put the spotlight from banking to pharmaceuticals then. That sector is in the spotlight. What are some of the key tailwinds? What's lined up for the big pharma companies? Lots to discuss. And we've got Keval Handa as well, who's now joining in. Thank you so much for taking time out. Just wanted to start off by getting a sense from you as to what is your outlook on the overall companies with a strong domestic business and how you expect them to pan out, because a couple years ago, of course, it was that COVID factor that then seemed to have waned off. What's the outlook now in terms of how domestic businesses for pharma is likely to shape up?
So, very good morning to you, and thanks for having me. I moved from pharma to finance, joined the Union Bank as executive chairman, and now moving back to pharma. It's quite an interesting time. Well, I think the COVID had one major drawback on the Indian profitability, was mainly of the returns of goods, which they had manufactured during the pharma period. By now, that problem has been put behind. Of course, we do see some stocks coming back, but by and large, that has been behind all the pharma companies. Pharma companies are showing a strong domestic growth, about 7 to 9%. Unfortunately, the global growth, particularly in US and Europe, is more or less flat. And whatever growth we are seeing is happening in outside US and Europe, and it's a good growth, about 6 to 7%. So going forward, we are seeing the US economy really coming brighter, and therefore there would be good opportunity for the Indian companies to play there. More or less, there is a good future because a huge amount of patents are going to expire in the next 5 years.
Chanda, good morning. Nikunj also joining in. If I look at the big picture for pharma, it's looking strong. The fact that US and Europe, they need to bring the healthcare costs down, and the generic model will continue to succeed. But that's really not been the story. I mean, there is extreme price volatility, there are serious cost checks, and this entire migration or this entire cohort where insurance companies have dominated the supply chain in US has had an impact on the generic pricing. So what to your mind is the big picture trend for next 2 to 3 years then?
So yeah, you're absolutely right. There has been a pressure on pricing, but by and large, the pricing have now stabilized around about 20 to 23% in the US market. I think that's a good sign. Indian market, you will see on an average 17 to 18%. So you're still driving a better pricing abroad than in the domestic market. Going forward, I say the great opportunity lies with us in the biosimilars, in the biological. The patents are going to be very huge expiry that is going to take place. Indian companies have taken a lead in this segment, and I look forward they coming out with huge brands and huge products in this market, and that would be a big kick to the Indian market. The other area that I'm looking at is how Indians' AI initiative is going to touch the pharma sector. If we are going to play well in the pharma sector, I think this is another big opportunity we have using the AI in the R&D. I think these are some of the great opportunity Indian companies have, and the domestic market is going to be very strong now going forward. I predict almost about a double-digit growth next year likely to happen. So pharma is really speaking on a very good wicket in the next few years.
What do you like within pharma? Where do you think the growth is going to be strong? Biosimilar is more like a global trend, but within India, will it be OTC? Will it be chronic? Will it be nutraceuticals? Where are you excited about the growth prospects?
So if you see the growth, traditionally we're still having the same growth in the cardio, the diabetes and antibiotic, but where the growth is going to come. The next big wave, and that's where the COVID has taught us, is the prevention. How do we start looking at ourselves and preventing any disease? And that's where the big market would be. Today, that market is unexplored, and there is very little opportunity there other than some OTC product, FSI product, or Ayurvedic products in the market. But if really the Indian pharma domestic companies starts focusing in that area, I see a great opportunity with their strength of marketing to dominate this segment.
Okay. Every sector, Mr. Handa, has seen a shift, organized, unorganized to organized, and within the organized, the smaller player has lost market share to larger players. Do you see that same happening in the Indian pharma space, where instead of 3, 4, 5 dozen companies, only half a dozen or 1 dozen big players would be left?
I don't think so that's going to happen. When we were there a few years back, 10 years back, we were talking about consolidation. But how many such consolidation have really happened? How many such companies, the regional companies, have come down? I think as people see opportunity in this segment, and it's not a segment where right now the entry barriers are very strong, or you will see new entrants coming in. You will see new people, the existing ones, putting more money on betting more money on their pharmaceutical domestic market. Consolidation is happening only at the top 100 companies, not beyond. And still there is a whole lot of unorganized segment which will continue to go and bite the big companies.
Final question, Mr. Handa. Every major sector has also seen what could be called as technology disruption. Fintech, where distribution models have been changed. Consumer tech, where food delivery and other online grocery has started. Even in areas of technology where SaaS and other factors have taken over. What, to your mind, sir, would be the disruptive move in the pharma sector? Because when you spoke about AI, sir, that's a process. But do you see some big changes happening in the pharma space, like what we've seen in the fintech and the consumer tech world?
So you've already seen some space in the e-pharmacy, online pharmacy. That is again disrupting the entire channel. You will also see now more disruption happen in this area, where institutional sales will get dominated by these e-pharmacy companies. And therefore, the channels are going to be disturbed initially very, very strongly by these e-pharmacy companies. In the next few years, the entire distribution model of a pharma companies will undergo a dramatic change. The other thing that is going to changing right now is within the large domestic pharma companies is how to service your customers, particularly your doctors or the hospitals, and what is the best way to service the customer. Is the feet on the ground the right way? Is the digital way to go is the right way? A lot of experiments are happening at this point of time as to service the doctors directly. Or do you take a support of a third party who is a very strong in digital to deliver your messages to the doctors? So I see another change that is going to happen is feet on the ground versus investment in digitals. So that's another change that's going to happen. Consolidation of assets and integration of assets is going to happen. The pharma company wants to own a lot of assets. But at the same time, there are going to be big CMDO coming up, that is a third-party manufacturers, which would also start dominating the space as more and more unorganized sectors and large companies would focus more on marketing.
The outlook in terms of M&A action really picking up, in particular in the branded generic space over the next few years. How are you looking at, strategic synergy really, shaping up for the long term within the entire pharma space?
So I think the branded formulation is a great opportunity today. There are very few assets and a lot of private equities and strategic companies are chasing these assets. We have seen success of this strategy happening in one or two deals that happened a few years back. Bharat Serum is just a point to make. And more private equities are looking at domestic formulation, given that this is a segment which is going to grow at 10%. So the quality assets today are being chased, and you could see a valuation going to around about 24, 25 for some of these best quality assets. And I'm seeing already happening that in at this point of time.
All right. Thank you so much, Keval, for taking time out and joining in, sharing with us your overall outlook on the entire pharmaceutical space, the road ahead, as well as what is really going to be that next booster shot, if you will. Okay, let's move right on then and hear it out from none other than Ramdev Agarwal. He shares his outlook on the markets and the sectors that he's bullish on. Listen in.
All the businesses, even the old businesses which are powered by internet, who are the businesses which are exploiting the power of, see, there are pure internet companies like, say, Zomato, Swiggy or Policy Bazaar. They are designed around internet. So they have a great chance to, if they execute well, they will become very large. Maybe not in 1 year, 2 years, but if you look at, say, next 5-7 years, I think they will become seriously large players in terms of profit pool also. That's my expectation. Nobody has delivered so far, so we have to see that. So that is one exotic, high growth, high probability event. It has not happened. So that is one frontier. Second is the say like Bajaj Finance kind of a company, which are traditional lenders, but using the power of technology. Say even the broking, where it has become all digital. Actually, the purest possible digital businesses in India are the broking companies.
Yes.
You know, whether it is Zerodha, whether it is Angel One, in terms of execution, we have still got lot more. We are a lot more phygital, I would say. Phygital infrastructure is there. Our lot of value is not coming from execution; it is coming from advisory. So we are phygital. But Angel One, Zerodha, they are pure digital companies. So and they are growing rapidly. You know, they become very large, seriously large. So you know, you have to really start seeing where all accelerated growth we can find, because multiples are pretty high. You're talking about 20, 25 and all. So clearly market is building in significant amount of growth. So where is the growth differential you can see? You know, and then so like among the traditional business, like real estate is very small compared to, I mean, multiples are high, but if you talk about the total profit pool, practically nothing. Till last year they were like loss-making types or no profit. Now current year 22 they have shown some profits. So that is one area where I think you can see if you're a good promoter, sensible guy, they don't go out of after seeing the current terrible thing. I think 8-10 years they are good. I don't think they are going to get into. They'll commit mistake again. Maybe new kind of guys will commit mistake. But I think this is going to create a huge industry.
Okay, so that's the sage advice coming in from Ramdev Agarwal. But also let's take stock of how Cen Tech is doing, because it was a bit of a weak set that the company reported this time around. Their revenue was flat year on year. The profitability has actually dipped by 23% sequentially, and the margins too have fallen below the 40% mark. Mr. Srikanth Nadella, the MD and CEO at Cen Technologies, joins us on the show. Srikanth, hi, good morning. Thank you so much for speaking with ET now. Well, what happened to margins? They have slipped below the 40% mark yet again. Is this pressure likely to continue for the rest of the year? What's the margin band?
Would you be able to repeat the question, please? Sure. There was a bit of distortion.
No worries, Srikanth. My question was on margins, because they have slipped below 40%. So my question was, A, what led to that? And secondly, what's the sustainable number that you're targeting for FY24 as a whole in terms of margins?
Well, thank you. First of all, very good morning to one and all. It's been an exciting start to this fiscal year. We have expanded our margin profile by 200 basis points year on year. Typically, financial services, especially in the mutual fund industry, which is our dominant business line, tends to be backloaded. So Q2, Q3, Q4 are much heavier numbers. So given that we have already hit our Q1 revenue numbers pretty much at par with that of Q4, and with the margin expansion by 200 basis points, we are confident of expanding our overall margin for the year end to be anywhere around 18 to 20%, and with a margin profile of anywhere near 43 to 45%.
You are in a business where a lot of changes are happening because of technology and because of the SEBI regulation. How do you see things moving, at least, let's say, on the mutual fund side or on the distribution side?
Absolutely. The changes that are happening, on the regulatory side are absolutely welcome and much needed. I think as the industry is poised to take off in a much grander manner, If you see over the last 10 years, the numbers have, practically double and triple in terms of the overall assets under management across all asset classes, whether it's equity or passives, debt, so on and so forth. And as the industry gears up to reach the number of 100 trillion over the next 7 years, which is a projection, there are structural changes that are required, certain guardrails that need to be put to ensure that the entire extremely regulated, well-regulated, business line of mutual funds continues to generate wealth for the investors. The regulation so far had been extremely pragmatic and proactive, which had been largely in the context of protecting the retail investors, and it has done an excellent job. As a SEBI licensed intermediary, it is our duty to implement, in addition to providing our own advice in terms of the policy formulation. None of this, I'd like to believe, that has provided any headwind or will provide in time to come.
If TRs are bought down, if more and more investors, they now choose to go to the direct platform, you don't see on the commission structure front and also on the demand structure or perhaps the new customer acquisition, things could change?
So the new customer acquisition is absolutely the most important aspect of it. Today we have a unique investor base in mutual funds, about a little over 3 crores, 3 to 3.5 crores. And, if you take a look at that as a percentage of the total population, or even as a percentage of the total investable population, it is substantively lower compared to any other country in this world. Probably roughly around 2%. And given every single year, a little over 20 million, youth come into the workforce who are more financially savvy, who are very well served by the digital ecosystem. We continue to believe that the expansion of the retail investor base will accelerate, from here on. Not to forget the fact that several more digital initiatives, that have been launched either by the asset management companies or by the registrars such as us, and new asset management companies coming into the foray. So new customer acquisition will be the most important aspect for driving growth. I believe all the digital infrastructure that is required has been put in place. Financial literacy is an idea that AMFI had been driving very, very extensively, something that I believe that will add a significant might in terms of the expansion of the industry across.
Okay. Now, the corporate registry business. More IPOs means more business. Less IPO means less business. Is this business which is cyclical? Is this business where it is difficult to understand how the growth would move because it's a function of A, capital markets, B, new IPOs?
Yes and no. It is. Let me just break down the business of corporate registry in terms of the revenue streams. We today have about 5,800 companies plus, in the Indian ecosystem as our clients. These have been the clients we've acquired over the last 30 years, and they provide a steady stream of revenue, which has nothing to do with the IPO market. That revenue pool constitutes little about 50% of the total corporate registry business, which, as I said, is not cyclical, which has nothing to do with the IPO market. The second big revenue pool is about the corporate actions, dividend declarations, buybacks, right shares, bonus issue administration, so on and so forth. These are the other lines of businesses which constitute roughly about 35% plus of the revenue pool in the corporate registry, which is to a certain extent cyclical. Obviously, if there are less corporate actions happening within the industry, to a certain extent, there will be a small impact. But with the large base of the corporates we have, there are enough corporate actions that happen every single quarter. That leaves us with the last 10 to 15%, which has some relevance to the IPO market, and a series of value-added solutions we provide in the form of technology solutions, including insider trading platforms and what have you, which constitutes the rest of the revenue pool. So broadly speaking, a good IPO market will mean better than anticipated revenue growth. If it is a subdued IPO market, we continue to demonstrate about 15 to 20% growth in the corporate registry business over the past 3 years.
So much for taking time out, Srikanth, and joining in, sharing with us the outlook for KFin Tech. That's the plan, to expand their margins by the end of this year, and new customer acquisition is going to be the key growth driver. Tell you what, we'll take a very short break right here on the show. Stay with us as we connect with and hear it out from the management of IDFC First Bank.
welcome back. Well, after starting in the green, the market has turned a bit sideways. In fact, we're just around that 19,650 thereabouts as far as the index goes. And in terms of stock-specific moves, it's Piramal Enterprises, which is quite active in the trading session today. Of course, it opened with a cut of almost 7%. Since then, it's recovered a bit. It's still down almost 4 to 5%, but at least off the lowest point of the trading session. The other one is Intellect Design. Of course, on Friday, that stock was logged in upper circuit, 20% higher. Today, it's seeing a bit of a profit booking, a cut of almost 5% coming in there. Green panel, it was a weak result reaction, and that's the kind of thumbs down it's getting. And Apollo Hospitals too down about 2% in the trading session. On the upside, just quickly, let's highlight BLS before we move forward, because that stock is up almost 10 to 11%. That's BLS International. But now let's listen in to the management of IDFC First Bank. V. Vedyanathan, the Managing Director and CEO at IDFC First Bank, in conversation with Nikunj.
It gives me great pleasure to bring on board Mr. V. Vedyanathan of IDFC First Bank to talk about this consistency in the number, which now first surprised everybody and now has delighted everybody. The bank has turned, things have changed, but is the change here to stay? Is this all about individual changes as an organization IDFC First Bank has done, or this is also about the massive tailwind the sector seems to be enjoying? Mr. Vedyanathan, another very strong quarterly performance, all-round growth, you cannot find fault lines. I'm going to start with a report from Morgan Stanley, which in their headline has said that good quarter, all-round growth, and we remain optimistic about the franchise value. This is coming from a firm which maybe 3-4 quarters ago, in a sense, that dismissed the great turnaround in IDFC Bank.
Well, you know what? They had a negative view on our bank for 3 or 4 years running. So for us, it's a massive endorsement, and coming from a brand like Morgan Stanley, who's known for good quality research and respected by global institutions, we think we're very happy about that. Yeah.
Okay, specifics now. What has worked for you for the quarter gone by? What were the factors at play?
See, actually, you should not look at what happened last quarter, because a quarter is a very short time. What we are seeing is a work done over maybe 3 or 4 years. People could not see it at that point of time because there were so many clouds, because of the legacy assets and this and infrastructure bonds that were high cost. So our real work of what we were building was clouded by these kind of issues. So today, those clouds gradually going away, the true model is beginning to show. So that's the way to think about it, actually.
Okay. So let's talk about the two factors. One, the deposit growth, stroke CASA, at a time when there has been literally a fight or a war of liabilities. You've managed to grow your overall deposit at 36%, sequential growth of 7%. It's been a tough time for the banking industry to get low-cost deposits, but you are growing at an enviable pace. Why, how, and will it sustain?
Actually, this is a very important question. Still, when people think of our bank, sometimes they think, look, can you really do this again quarter after quarter, particularly because deposits. Now, what is really, our CASA deposits, mind you, because money is moving to term deposit, CASA deposit is up 27% YOY. I think one of the key reasons is that we have now become a brand, and a good brand. It's not like more well-known. It's a brand with a certain character people associate with us. And a brand makes a huge difference to an institution, because it just swings. There are other banks which pay similar rates than ours. But I think it's very material for us, the way the growth is coming.
Okay. You are guiding for a steady margin trend, as the higher cost of funding will be offset by the repricing of MCLR and fixed rate book. Could you elaborate more on that? Because at a time when interest rates in India are peaking out, historically we've seen that margins, they tend to peter down rather than stay robust.
That's a good question, actually. See, in our case, there is it's no doubt that the cost of deposits is catching up because deposits cost catch with a lag because fixed deposit rates, the way it works, or the stock repricing. But for us, there is also a countervailing factor where we're repaying. Remember, we're repaying about 20,000 crores or 17,000 crores of 9% money, and we're replacing them with probably 6% money. So we are getting a benefit there. So that kind of offsets. We do still believe that our margins will be, like currently it's down about, I think, 9 basis points over last quarter. It should be somewhere here. Even if it comes down by a few basis points, maybe 4-5 basis points, really we don't bother about these things because we have a pretty good margin already. And actually, it should not make any material difference to our earning, profits. Don't bother about that.
Okay. So one has to, let's say, talk about the big picture and without getting into specifics of numbers here, but just something on the trend. This kind of growth, what you've reported for FY23 and the first quarter of FY24, do you think this kind of a trend, both in terms of growth as well as trajectory, will it sustain for at least next 3 more years?
I'm very, very confident of that. Let me put it like very straight. We feel that our operating profit will continue to outpace our loan book growth. Our loan book, as you know, we guide for 22-24% in that zone. But let me just say our profit will outpace it because we are getting the operating leverage kicking in. Let me tell you one number, for example, Nikunj, just for this quarter that's just ended, YOY. Our loan book grew by 24%, but our NII grew by 36%. Our operating profit grew by 45%. Our PAT grew by 61%. How's the magic happening that you grow the loan book by X, but operating profit grows higher? I think it's fundamentally very strong about the business model.
Okay. Historically, there has been a drag because of your wholesale book. And I just want to bring this point out for our viewers. That in a sense was also dragging the aggregate picture down. But now you are at the tipping point, like you just mentioned, in terms of the other businesses which are firing full cylinders. Do you see the entire migration of the drag of the wholesale book and that adjustment? Is that behind IDFC?
Yes, we don't think any material loss is going to come from the legacy book. That story is over. But there is one upside waiting for us here, at least we feel, and you will see it. In the infrastructure book, we still have about 4,000 crores of loan book, like 3,600 crores. There our NPA is 23%. Our net NPA is 15% there on that book. So we are pretty confident that that book will go away in 2 years. So when that book of 25% or 23% NPA goes away, the rest of the book, which is retail, SME, and corporate, they are like really good. At least I'm looking forward to those infra. It will be a tail infra going away.
You've done many first, if I may use the term, in terms of renovating the entire rules of the banking industry. A new scheme for credit card, very high on customer experience, a very strong interest rates on savings for savings and for fixed deposits. What is the next big innovation we should expect from IDFC First Bank now?
High rate was not an innovation, actually. We were paying a higher rate because our bonds were at 9. Even 7 looked great for us. That's why we're paying. But now we're paying only 4% of a 10 lakhs in savings. It's not like a massive difference. But the big thing is that really we are like going crazy about customer service and customer experience. Normally nothing upsets me in life, but this thing about here, customers are upset about something. It really, it bothers me. So we are like trying to build a bank systematically, which is very, very high on customer experience. We train our employees, we motivate them, we tell them that customer is everything. So we are trying to really build a customer first bank. You'll be surprised. This is not just, English mumbo jumbo. Actually, there's a lot of power in it. When people experience the brand, they refer us ahead. Even at reasonable rates, you'll get a massive, alpha on deposits if customer service is good. That's what we're trying for.
As you grow and as you continue to grow at a rate which is much higher than the industry average and much higher than what your peer sets are reporting, how would you take care that the balance sheet does not get over leveraged and risk is not compromised?
This is really a very important question. I'm actually happy you asked it. For us, frankly, we are guiding only for 22-25% growth. First of all, we're currently growing at 25, but think of it like now in this country, when even large banks like ICICI Bank, HDFC Bank, after being 25 years in business, are still growing at 20. For a low base, 25 is not a big deal. So that's one thing. But the more substantive reason is that this is a very key reason, we track and we lend to cash flows. So this is very important. And we are not lending to equity. So say, oh my God, I got a home or a car. All that is of course important, but we are lending to cash flows. We see money in the bank or assess money in the bank.
Exactly a year ago, everybody was over-obsessed understanding that what implications the fintech revolution will have on the banking sector per se. The fintechs were innovating, the balance sheets were cash funded, they were growing by burning equity capital. But given where interest rates are, how valuations have reversed for the fintech space, do you think this entire fintech fear which was there, is that fear now behind us both in terms of innovation and eating into market share of traditional Indian banks?
I actually, if you don't mind, I was on the contra side of it. I actually felt that all that is opening the market. When you think of fintech, think of all the technology firms who are adding value to a loan process or a deposit process. That is itself very big value. Second, as for reaching out the market is concerned, I even then believed, even today believe that every one of them opens segments of market which traditional lenders may not do. And that eventually comes to the lending system. So you could think of Geo like that, or you can think of any other technology.
Mr. Vaidyanathan, if I map the journey of IDFC First Bank, in COVID it was about survival, then it was about burning the midnight oil and turning the franchise around, which you've done, and then in middle of that came the IDFC and IDFC First Bank merger as the trigger. So it has worked beautifully for minority shareholders. Every 6-8 months, they've got something really exciting, which in a sense has re-rated the stock. So for next 12 to 18 months, what really could be the trigger?
Funny you're saying that, because the first 2 or 3 triggers were actually bad news for investors. First we announced, loan of, Diwan housing going down, then we announced the Reliance Capital.
Okay, so that was the interaction with the IDFC First Bank management. For the markets, we are holding on all right. It's not a runaway rally, but at least we're maintaining on to gains and actually building on to gains very steadily. We're now inching closer to the 19,700 mark. In terms of the sectors, well, it continues to be banking, which we're watching out for, though it's underperforming today. And then in individual names, it's Siemens, which is doing quite well. Bandhan Bank, there was a large trade, so that's in action. Power Mech on account of that large project, and BLS International is the other one that we're watching out for. But time for the Chartbuster segment with our technical experts on the show. Kunal, tell us what's the Chartbuster idea?
So it's actually on the Nifty 50, that's the benchmark index. And what I wanted to showcase today was that how trends shape up when, or every trend has a certain set of a behavior for itself. Now we all know that, in March 2023, the index was at sub 17,000 levels. Now this was the point when the index was at sub 17,000 mark for itself. Now post that, we saw a start of a fantastic uptrend for the index. Now this uptrend could be simply categorized with the fact that the index has been holding on to a simple key moving average. As you can see, this red line which has been moving for the index. What is this red line? This red line is a 20-day moving average for the index on the short-term charts. Now every time the index goes into an uptrend, there is a mild correction. We see the index taking support at this 20 simple moving average. This was the period in May where the index corrected towards 18,000 mark. This was the recent correction where the index ended its correction at 18,500, 550 levels. And this is the most recent one where we are trading right now. This is the end of Friday's trading session where we are closer to that 19,500 mark, which is again a 20-day moving average. So in the last 4 attempts of this consolidation, we've seen that every time the index comes into a point of mild correction, it takes a support at this 20-day moving average, bounces back and then crosses above the previous highs to start off or to kickstart a fresh uptrend for itself. I'm expecting similar trends this time around for the index. So closer to the 90,500 mark, I think one should be a buyer on the index, expecting index to break past above the previous highs of 90,990.
Okay, that is a view coming in on the Nifty this year. A pretty bullish stance from Kunal. Let's get in Naresh's Chartbuster idea as well. Naresh, what is looking good today?
So, looking at a longer term bet on Ashok Leyland. Now, if you look at the stock, 170 was a top back in 2018. Then in 2021-22, that was a zone. And again, this year, multiple times it got a resistance around 170 levels. Finally, a huge cup and handle breakout done. Made the initial move to 185. And now is the time that this consolidation between 175 to 185 is to accumulate. Eventually, the stock could head up towards 225 levels. Buy at current levels as well as on dips, stop loss at 170.
Ashok Leyland, that's the Chartbuster idea. But what are the stock picks coming in from our chartist? Kunal, you go first.
PNB, Punjab National Bank, is the first stock which I would suggest as a buy. Again, the stock coming out of a mild consolidation, yet to give a breakout. So would anticipate that for PNB. Targets of 72, stop loss at 58. And the second would be one, Balrampur Chini. The stock is heading towards a breakout above 400 mark. Second attempt towards the 410 levels for Balrampur Chini. Would suggest a buy with a target of 430, stop loss at 398.
What about you, Naresh? What's the idea?
So first would be a bounce back trade on ABFRL, stop loss at 220, target price of 240. Second would be Tata Chemicals, which has continued on the momentum, finally broken out, stop loss at 1030, target price of 1150.
All right, that's the view coming in from the Chartbuster stock recommendations. We'll take a very short break then right here on the show. Be right back as we connect with some top corporate voices, Nazara Tech, Green Panel Industries, that and an update on the monsoon coming up.